What's going on, everybody? Michael Silva, you're watching the Stock Market Brief. We got the CPI data coming out tomorrow morning at the market open, and let me tell you this, the market looks like it wants to rally, so it's going to really depend on what data comes out for this inflation report. Is it going to come in hotter than expected over these consensus numbers, or is it going to come in under? I've been seeing some stuff that it's going to be cooling off, and I've been seeing some data that is going to show that's going to show up hotter. It could just land right in the middle. Now, I'll explain why the market looks like it wants to rally, but let's first look at a bigger picture time frame. We're underneath a 5-period monthly EMA. And we still, remember, we talked about that right here as it was coming in, right? Because it got so extended, it came right back and tagged it. Now we're selling right back off. The red shaded area is the bear market territory. Now there's a couple lines on the screen. The lines are this. This is the quarterly expected move, the dashed lines. And then the solid black lines are the monthly expected move. And as you can see here with the S&P 500, we're not too far off the bottom area of the monthly expected move. What I find interesting here is the Qs. The Qs actually tagged the lower edge of the monthly expected move to the T, and we started bouncing from that area. You can see we got extended right here from the 5-period moving average. We started bouncing back up, we tagged it, and then we started selling back off, continuing that downwards trend. Overall, if you look at the PPO, price percent oscillator, on both of the S&P 500 and the Qs, they're both pointing down. They got wind in our face, okay? So what I think here is like, okay, so the downside could be potentially limited. However, when you really break it down, you're like, okay, well, the quarterly expected move is down here. So there is still the possibility for a trap door to be set. So be very careful on this report. We'll talk about exactly the amount of movement that the options market is pricing in momentarily. If we take a look at the IWM, the IWN here actually did just about touch its quarterly expected move right over here. You can see that dashed line still within bear market territory like the other index products. Upper monthly expected move, lower monthly expected move, and we're not too far off of that. It's right there at about 170. You can see down here is the lower edge of the quarterly expected move, which would be absolutely brutal if it touched it. Now, go ahead and screenshot this picture. The reason why is because these are the expected moves for tomorrow's print. Now, when CPI comes out, it's very likely to see volatility increase, obviously, right? That's what the market is pricing in. These moves right here, it's not just like, hey, it's going to go down this much. It could go up this much, or it can go down this much, right? So these are expected moves. Expected, they're trying to handicap forward-looking risk. That's what implied volatility is. Okay, we use historic volatility, we use implied volatility to help us kind of gauge where the market may go. Now, if we look at the SPX is, you know, the big boy product over here. And this right here has an option actually expiring tomorrow, and that's looking at a plus or minus $75 move. The SPY, the Qs, and the IWM do not have the option expiry coming tomorrow. It ends on Friday, so I'm just giving you the updated what it looks like priced in till the close of Friday, and this can obviously change. These are dynamic. Okay, but these are the upper levels. These are the lower levels. You can see here tomorrow is looking at about a $75 move. The SPY, we can move $9, you know, in the SPY, $8 in the Qs, potentially $5 there, roughly, in the IWM. So these are the upper levels, these are the lower levels. If we get into the 15-minute time frame, I'll show you more specifically what that looks like. The SPY has the orange line. Those are the expected moves as of currently for the CPI report. The dashed lines that are black are the weekly expected moves. Now, what I find interesting is we're below the declining 5-day moving average again. It's rather neutral if you just look back through history. We're right there in that chop box, right? We're boom. You can see every time that we come into this chop box, we just see what? Well, we see chop, and we've been seeing chop. Now, as it stands right now, and why the market could potentially looking for some reason to rally, this is where breakdowns can occur too, but you can see RSI is getting to that lower level there, right? It was already a pretty aggressive day. We're wedging here very tightly. So if the report comes in hotter than expected, boom, we can get hit, and we get hit hard fast, okay? Right there at the market open. But you got to be open for the possibility that, hey, this little wedge pattern, and you know, even if it comes in hotter than expected or even or whatever the case may be, the market might press it up and try to work out these overextended levels. So you got to be very kind of tactical in how you play this. Maybe look at these key levels on how you may want to position if we hit those levels come into tomorrow morning. But as it stands right now, overall, if you just look back to the 19th of the prior month, actually September, I'm looking at a few months here, you can see that we haven't actually moved anywhere. We've just been in a chop box. So as we're trading in this range, you can play tactical levels. Those tactical levels would be something like 370, right, for a potential bounce, or you can go ahead lower right around here, which is 365, and that lines up with the lower CPI move, and it lines up with the lower weekly expected move. But if we just jump up really, you know, powerful to the upside, okay, well then start looking right here at about 382.50, you know, this prior peak high, and then also up here at 87.5. So yes, chop. So you got to be, once again, incredibly careful. If we take a look at the Qs, it did break down from that little bear flag structure right there. We're looking at about 255 for the CPI expected move to the downside, as well as the weekly expected move there too. So can this get some follow through? Well, it got beat up today, got hammered, right? We have a lot of that news around FTX completely just blowing up, and crypto, you know, it got completely obliterated. I'm not going to really talk too much about crypto. I haven't been talking too much about crypto because it hasn't been moving, and on top of that, it's been looking very bearish, and now we're seeing the repercussions of all of that. So if I do make a video, it's going to be just a separate video on all of that. So yeah, so keep an eye on these levels right about 271, and then up here at around 275 for those weekly expected moves. I do believe that the market is going to be tagging one of these here in the next couple of days because the implied volatility is telling us that, hey, expect it. If you take a look at IWM also broke down from that bear flag, also getting a little frothy here to the downside, as you can see. And we've been just it was just kind of just a direct sell off. It wasn't anything, I mean, it was a violent sell off, but it wasn't violent in the say of just a huge move to the downside. Like it was a steady bleed out grind to the downside. And we're below that declining 5-day moving average. We're not too far off the weekly expected move. The CPI expected move brings us down to around 170. So be careful. Like if we get the report and it's just a quick hit to the downside, these levels, they're going to be super, you know, burned to a crisp. And that's really typically where people are like, okay, now I'm going to sell everything. All right, I'm going to get out of my position. I'm going to sell everything and I'm going to short it or something like that. And then at that point, you get some sort of rip your face off type of rally that you got to be well aware of. And the same thing goes to the upside. It comes up way up here really quickly, a big old move. People are like, okay, now it's time to go long. Now I'm going to go in long right now. I'm going to cover my shorts. And it's typically a portion where you get capitulated. All right, let's take a look at the zones. Ignore the SP100 right here. That was a mistake. But I do find something interesting here. These are something that I share with my Patreon. I've been sharing it here on YouTube too. If you want to join the Patreon, it's $9 a month, or just save annually and just pay like $90 US. And I give swing trade ideas. I give my weekly watch list when I have it updated from the long side. It's a long-sided watch list, so it hasn't been updated as frequently. I give expected moves. I track about 40 products, and then I give these zones too as well, which I haven't listed over here. And by the way, if you're a Patreon member already, I'm updating the zones to be a lot different. I'm gonna actually be including a lot more products in these because it really does give a good view of the overall markets. So I'm gonna be including international ETFs, currencies, and just a whole lot more different products, so you can get a good macro view really quickly at, hey, what's going to the higher end, what's going to the lower end, and give a good idea of, hey, what may be moving, you know, in the market. So really quickly, you know, we talked yesterday about semiconductors and miners yesterday. And miners got hit, and they got hit hard, and then semiconductors got hit, and they got hit hard. So you can see that obviously it changes where it lies within the overall zone. And right now what I'm noticing is gold is in the red, right? So it's getting to the upper area of that area. But what I also found interesting was HYG, smart money. Smart money, right? If high yields are going down, typically you have a strong correlation with other big assets like, well, the stock market, okay? Like including like the big mega cap names. And what I'm seeing here is, okay, well, HYG is reaching the lower range. So this might mean that the bleeding might stop. Now, this doesn't calculate in and take into effect what's going to be on the CPI report, but it could be a good indication of, hey, you know, the market front runs this type of stuff. So maybe it front run it already. Maybe it knows it's going to be taking place. We get a report, and then all of a sudden the market rallies. Like I said, the market is looking for a reason to rally, and these are just narratives here. But as I'm pointing out, HYG is currently at the lower range of this. And then you take a look at Apple and Tesla. Tesla is getting absolutely hammered, and it's the lower area of the zone. And then also Apple is too as well. And Apple is the largest company in the S&P 500. Okay, huge market cap. So if these big tech stocks and consumer discretionary stocks start to rally, that can actually bring the markets up. So that's something to be aware of. Another thing I found interesting was ARK, right? ARK is, profitless tech companies getting completely hammered. Those are at the lower range. And then you have XLY is also at the lower range. And XLY includes Tesla. It includes Home Depot. And some of these names, they've been getting completely hammered, okay? So what I'm seeing here is overextended to the downside could potentially bring on some sort of a bounce. Now, Bitcoin also obviously is getting completely ripped to shreds. And as you know, Bitcoin was that whole FTX thing, and you're seeing, the start of big, massive implosions, and we don't know what the repercussions of all of this are. So these aren't set in stone things. These are help you to manage risk and be aware of where price lies within these zones. And if you take a look at the dollar, right, the dollar had the like we talked yesterday, right? It had more upside potential because it was already selling off. And when things sell off, they typically bounce. And now where are we? Well, we're right back there about in the middle of the range. So it's, once again, very binary. If you take a look at the dollar more specifically, it came to the lower area and we started to see that little bounce there. And as we bounce, guess what? S&P 500 got hit. No news there. If the dollar wants to continue to move to the upside, S&P 500 is going to most likely get hit. The correlation makes sense. It's been making sense. There's a negative correlation. And then also that matches up with other assets, which we talked about, like various mining stocks. And I'm not going to get into it in this episode. I'm trying to keep it a little bit less. If you take a look at the 10-year yield, the 10-year yield is probably going to break out of this 5-day-ish consolidation here come tomorrow on the CPI report. So look for a break to the upside or the downside coming into tomorrow's report. If you take a look at yields, still looking at a 10 and 2 curve, at minus almost 50 basis points, in the 10-year 3-month at minus 17 basis points. This is just, part of the bear market, right? Things aren't getting better, right? So we'll see bounces, we'll get more people sucked in, but every single bear market rally that we've seen got sold off. Okay, so if we get a continued bear market rally, and it's only been what? It's November, it's been 11 months. Bear markets typically last longer than that if you just look back through history, okay? If we take a look at a couple other indicators, the summation index, we're still actually on that buy signal, which triggered right over here. And, the trend is going up, but, this may start turning around soon, perhaps. And then you get the parabolic start to uptick, and that could give us the indication that we're running out of steam and this thing could come back over. And if you look at the New York Stock Exchange, right, that's a broad market. And if I were to just draw a line in this trend, right, I'll draw it from over here. We'll draw a trend line down. You can see that the price action is not too far, from this trend line where we get hit, came up, and then hit. Now, yesterday we talked about the higher high over here, and you can see the lower high over there. And we played a little bit more to the downside today. The last summation index I want to show you is actually the NASDAQ summation index. NASDAQ composite is obviously a very big deal, right? And one of the big components of the NASDAQ composite is obviously semiconductors, right? If you want to see growth take place, you want to see, semiconductors perform well. It's a huge part. And semiconductors got hit. You can see the NASDAQ composites right around a new closing low. It's not a new closing low for the year, but it's just about there. And you're starting to see the summation index kind of slowly curl right there. So, if this is the start of a potential, something like this, the parabolic star is going to start upticking it, and that could start a trend to a breakdown over here, which could head us lower, okay? So it's not done yet. We still have the parabolic star underneath and the summation index up. But like I said at the very beginning of this, the market is looking for a reason to potentially rally as we're reaching into overextended areas. We're getting things completely burnt to a crisp. So if the data comes in lower than consensus or right around consensus, that could set the stage for a rip your face off rally. So just be prepared for something like that, okay? Hope the levels helped out. Hope this helped out, just the zones and everything. And be careful out there. See you later.